When real estate is being sold, the highest price doesn't always win. Investors understand this, and that's why they beat regular buyers so often. And once you understand what sellers actually care about, it becomes clear why investors have such a big advantage. First, let's get into what sellers actually want. Most people assume that sellers just want the highest price, and that's only partially true. What sellers really want is certainty and speed, and a deal that won't fall apart at the last minute, because a failed deal is extremely expensive. If a sale collapses, the home has to go back on the market, other buyers may be gone, and the listing can go stale. And later on, the seller may have to agree to a lower price. So from the seller's point of view, the best offer is often the one most likely to close cleanly. And that's where investors shine. One of the biggest things that investors are able to offer is cash. Because what you may not know is the biggest risk in most home sales is financing. Because a normal finance deal depends on the buyer getting approved, the appraisal coming in high enough, and the lender not changing terms last minute. Any one of those things can kill the deal. But cash eliminates almost all of that. And that's why cash offers are so powerful. And investors in many deals are offering cash. And cash eliminates that financing risk entirely. In recent data, roughly 1 out of every 4 home purchases was made with all cash. And among investors specifically, more than half of purchases were cash. So when you're making an offer with financing, you're very often competing against someone who doesn't need a bank at all. Let's look at a real life example. Let's say you offer $720,000 for a home, you put 20% down, and the rest is on financing with a 30 to 45 day close. An investor, on the other hand, can offer $700,000 down, all cash, no financing contingency, and a really flexible close date. So even though your price is higher, the seller may take the investor's offer because it's much more predictable, it's going to close a lot faster, and there's almost zero chance that it'll fall apart. So from the seller's perspective, that reliability is worth more than an extra $20,000. And even when investors have to finance and borrow money, they still make it feel like cash. Because here's something that most people don't understand. Not all cash investors are actually sitting on piles of cash. Many of them are using lines of credit, bridge loans, short-term financing, business loans, but the seller doesn't care what the money comes from. What matters to the seller is how fast they can get the cash, how fast you can close, and the most minimal risk. And an investor might buy with cash, close quickly, and then refinance later. But to the seller, that's still a cash deal. And regular buyers usually can't do this because they need the mortgage to buy the home, they can't float the purchase, and they're constrained by lender rules. So even when investors use leverage, they structure the deal to look safer to the seller. And investors can take risks regular buyers can't. When regular people buy homes, they're rightfully cautious. They want a full inspection and protection if the appraisal comes in low, because they're buying a place to live. Investors think differently. They often waive minor inspections, buy as is, they already have a budget for repairs, and they may already have contractors lined up. They're not buying perfection, they're buying a number that makes sense to them. So their offers typically have fewer contingencies, fewer chances to renegotiate, fewer reasons for the seller to worry, and that makes their offer stronger even at the same price. And another big thing for regular buyers is that they're typically capped by their monthly payments. Most regular buyers are limited by debt to income ratios. So a regular buyer may love the house and want to offer more, and the bank may simply say no. Investors don't always have that cap. They may be thinking about rental income, long-term appreciation, portfolio diversification, or future renovations, so they can sometimes justify a price or a structure that regular buyers just physically can't. And this doesn't mean that the investor is reckless, they're just evaluating the deal differently. And investors, they typically stay active even when most regular buyers pull back. This becomes really obvious when mortgage rates rise and affordability gets a lot worse. With rising rates, you'll often see regular buyers kind of stepping aside, and when that happens, investors often become a larger share of the buyer pool. Not because there are more investors, but because there are fewer regular people competing. And that's why in recent years, investors accounted for a much larger share of single-family home purchases than people expected. So if you're buying in a tough market, you might feel like it seems like every house is going to an investor. And in some markets, that feeling is actually real. And another consequence of higher mortgage rates is that it causes many homeowners to delay their plans of moving somewhere else and putting their house on the market. Because if you already have a 3% mortgage and you're gonna have to sell your home and buy another house at a 7%, that's extremely painful. So a lot of people stayed put, and that actually starts to reduce inventory. And when inventory is low, competition from buyers, that includes regular buyers and investors, starts to intensify, and sellers have a lot of leverage. And when they have a lot of leverage, the strongest offer typically wins. And the strongest offer in these cases usually means cash, speed, fewer conditions. And that's why you start to see in sellers markets, a lot of people, they won't even do inspections on homes because homes are being sold so fast, you have to waive all these things. And all of this again starts to favor investors. And when you hear me say investors, a lot of people are kind of thinking giant corporations. And that's not really all that we're talking about. A lot of investors are just small operators who have done this before. They know their local markets. They already kind of understand repair costs, and they work with the same agents repeatedly. So they have a deep understanding with kind of the real estate market. And it may be just someone who owns like 3 or 4 homes and they're looking to buy another home. It doesn't necessarily mean that we're talking about BlackRock or trillion-dollar institutions. Regular people who may have 3 or 4 rental properties have a lot of experience in the game. And that experience lets them move a lot faster, estimate risk better, and submit cleaner offers. To a seller and an agent, that experience matters. A confident, experienced buyer feels safer than someone stretching their savings for their first home, even if both offers are similar on paper. So what's the real reason investors win? It's not because they're evil, it's not because they always pay more, and it's not because regular buyers are doing something wrong. It's because investors can offer certainty, they can offer speed, they can offer flexibility, lower risk, and they're looking to get deals done ASAP. And in real estate, lower risk for sellers often beats higher prices. So the real takeaway from this video is that when investors outbid regular home buyers, they're usually not actually winning on price. What they're really winning on is being able to offer cash, doing a lot less inspections, moving really fast on the close, and having a much higher risk tolerance. Now, I know just because you understand this, it doesn't mean that if you lose a bid to an investor, it feels any less worse. But I hope you guys can kind of understand the rules of the game now, so when something like this does happen, it doesn't just feel like random bad luck. You actually know what's going on.